Hello. So we are going to cover today the topic of the policy environment. Particularly, we are going to focus on the monetary policy and how the central bank adjusts to everything. All the social, economic, and political environment is very important to set the right interest rates. Particularly, today is a very interesting day because the Fed was going to set some rules in order to increase the interest rate. So everybody was expecting the Fed to say how many increments in the interest rates we are going to have in the next months. The Fed did not say anything. So it's a very it is very important because among the principles that they state was the fact that they want to follow the data and what they are seeing in terms of what is going to be the economic overlook for the economy. So I believe that they feel at the Fed, Jerome Powell, he feels like he's like at crossroads, right? So on one hand, the interest rates are at very lows at the moment. Unemployment is also very low. Growth is very high. So there is going to be an increment in the interest rates in March 2022, this year. So we are going to have some volatility in the markets. And at the moment, today, the markets, the stock exchange, and the volatility in the bond yields is very high. So let's see what happens next. My vision for or my outlook for these markets they are going to keep being fluctuating in the future a lot. So let's see how can we write that in terms of the speculation, right? What can we do? And also let's look at how the Fed is off track because inflation has been deemed as transitory. The Fed did not do anything for months. It is still in quantitative easing mode. It's going to finish in March 2022. Many economists in the area are saying that the Fed is behind the ball. So it's going to be very nice to see why, and as well to debate how many rises in interest rates the Fed is actually going to be able to perform. There are like many different of opinions in the market. Some of them say that they are going to increase 8 times the interest rate in every month from March. Others say that only 5, others say that only 3. The fact is that apart from increasing the interest rates, the Fed also is looking to quantitative tightening. So that is the opposite to quantitative easing. So instead of printing money, they are going to collect some of the notes, some of the liquidity in the market, and that is going to cause serious consequences in the markets. So the Fed is in a crossroad. If they increase the interest rates, the markets will fall. So they are trying to maintain both like increase the interest rates and keep the markets up, but that is going to be very difficult. Okay, guys, so let's go to my full desktop and let's start with a very interesting video about the Taylor rule, how much for how many points of interest rates the Fed is off track following this Professor Taylor from Stanford University. So let's then see this quick video. I think I will need to as well to change the actual settings here. So this is going to be able to follow the sound of the video. Okay, so I think I did right.
Great to have you. Talk to us first about perhaps maybe some of the different shifts that maybe the Federal Reserve has seen relative to maybe what you're looking at. A lot of people have said that the Fed, it's clear they are behind the curve. How do you think we've gotten so far behind the curve?
I think we are behind the curve. I think that's one of the reasons we've seen inflation picking up. I think the reason is it was a very serious hit to the economy. And it was sort of shocked. But I think, at least for the last 3/4 of a year, maybe longer, it's clear that they needed to start moving. And I think just a little reluctant. They had to see the data, had to look at it. But I think that's really the reason for the slowness. And depending on how you read Jay Powell's statement today, I think they're beginning to see that and take action.
There's been a lot of talk here about the flexibility that the Fed, the FOMC members want to have to be able to sort of look at data, react to it, or in some cases not react to it if they think that it's going to be a relatively transitory here. Do you think that the flexibility as it currently stands with Fed policy is maybe a little bit too flexible?
I think it's off. It's flexible in the wrong direction. I think, if you look at the history of rules, like the so-called Taylor rule, you see when they've gotten off, it hasn't worked out so well. When they're on track, it works pretty well. So that's the lesson. And I think by any measure, they're off track now. And they have been for a while. And so they need to make that adjustment. And I think it would be better for the economy if they make the adjustment sooner rather than later, and smooth and as forecastable as possible. But we haven't got to that point yet, and they're still talking about the future.
But the Fed's new framework implied that it was going to drift away from these sorts of rules. They decided that they wanted to have that flexibility, particularly to overshoot on inflation, to have a more inclusive labor market. But suddenly it's felt that inflation has run too hot, and inclusivity in the labor market perhaps isn't the main focus when indeed the world is upended from a supply chain perspective. Should they never have built in that flexibility? What do you make of the newer framework of the Fed and whether or not it works?
Well, they made this adjustment, this average inflation targeting idea, but you can plug that into a rule and you can see what it implies. And also there's a debate about the so-called equilibrium interest rate, which people call R-star. John Williams has done a lot of work on that. There's debate about that. But even when you put those in, it looks like the rate is too low. And if you assume inflation comes down, it's still too low. And so I think that people have to take into account, it's not one particular strategy or rule. It's a whole set, and the Fed actually publishes these in its monetary policy report, page 44. I wrote it down. The most recent one, they're there, sitting there, the Taylor rule and others, and you can see how they're behind the curve.
What about the structural shifts that have been created from the pandemic? We heard from the Fed chair earlier, and I believe it was last year when he said maybe the natural rate of unemployment, it's a lot higher maybe than it has been in previous cycles. Do you see those structural shifts underway as well?
It's certainly possible, and I think that's what the Fed is banking on. But again, the magnitudes are not nearly large enough to have this rate near zero, as Jay Powell put it. And I think the notion, he used the word twice, very, very strong labor market. That's there. The notion of the federal funds rate is the primary means of adjusting policy. You said that as well. That's part of the principles. So all those suggest that it's about time to be clearer, more systematic about the rate increase. And people are writing about that. I think they're concerned. There wasn't much discussion of that in the press conference, which I watched. But I think people are talking about it all the time. You're seeing it in the Financial Times and the newspapers, Wall Street Journal, et cetera. They're beginning to see that there's a problem here.
But when you talk about the rules that the Fed lists out in its policy report, I mean, they all sort of include, I guess, the employment gap to some extent or another here. With regards to the inflation gap, the gap between expectations and the trends that we see here, can we blame maybe part of the lag in the Fed response to the idea that these were much more supply side issues? They were happening in certain areas of the economy that don't necessarily show up immediately in those sort of headline inflation numbers. Is that a valid excuse?
I don't think it is. We've seen this in the past. That was one of the excuses raised way back in the 70s. It's the supply side. It wasn't a monetary policy. But I think it is monetary policy because we have evidence that the rate is low compared to what history would show you. Your charts show that. We've never seen it like this in the past, so they need to make an adjustment. I don't think it's that unusual. Of course, the pandemic was terrible and very unusual and still there, but I don't think it's sufficient by any means to justify the near zero rate.
And meanwhile, cost of living prices continue to spiral, particularly the rent side and how much the Fed can affect that. Very quickly, Professor, is there any way they can orchestrate now a soft ending to what has been an economy running hot?
By all means, and I think that's what we hope they will do. They'll begin to make the adjustments. Maybe it'll take more than what's in the cards, which is only like 0.9 by the end of this year. And I think it should take more than that. But if, again, it's advertised, it's clear, there doesn't need to be a contractionary effect. It'll focus on inflation, and that's what the Fed should aim for. The economy doesn't need a downturn at all. That's completely ridiculous. What it needs to be stronger, and it will be stronger if we deal with this inflation problem.
So yes, this was then the video that I wanted to share with you. Very important takeaways from this video. Probably I will say that Professor Taylor, well, he is not the one who created the Taylor rule, by the way. It's just a coincidence. But we are going to talk about the Taylor rule later on. But I think the takeaways will be that the Fed is indeed behind the ball, meaning that interest rates are too low. So following the Taylor rule, interest rates should be in 3% already. So the Fed is only proposing an increment in interest rate in 0.25 basic points in March. So there is a scope to actually increase more the rate of interest. The problem is probably this has not been addressed by this video, this recording, is that the difference between the 10-year yields and the 2-year yields are showing that that difference is just probably showing that the Fed is only going to be able to increase the interest rates 3 times, right, or 4 times perhaps. Otherwise, what is going to happen is that the short-run interest rates are going to be higher, or the short-run yields are going to be higher than the 10-year, the long-term 10-year yields. That means that we will have an inverted curve in the yields, and that usually is like the warning for a new recession. So, yes, I believe that therefore, because of the risk of a recession and the risk of this very high inflation and the economy overheating in the United States, it's going to be very possible to get a recession if. And I believe that is the reason why Jerome Powell delivered a very dovish statement today. So meaning that he is a little bit lazy to increase the interest rates, but at the same time he didn't say anything about what is going to happen next. My speculation about that is that he is thinking of increasing the interest rates in month by month, at least for 3 or 4 times this year, and he doesn't want to tell the markets, so the markets are not going to fall today, right? I think he's preferring the fact that he's going to analyze this. He's going to say, I'm going to analyze the situation every month, and I believe that that actually has the potential to create very huge or very high volatility in the markets. In my opinion, is better when you know how many times you are going to increase the interest rates. So let's see then what are the policy environment issues. I think I cannot find my mouse here. Let me see if I can. I need to change to this screen. Yes, so here we are. So as from the talk that we were having before about the Fed, we can see that there is a case for automatic rules. So at what extent we can use certain indicators to decide what is going to be the interest rates. And these cases for rules raises the issue or the notion of the Taylor rules that we are going to discuss later. So the case for having a rule, for instance, a rule saying that interest rates are going to depend on inflation and unemployment, as in the case of the United States, or inflation and GDP, such as in the Taylor rule, yes, is that it addresses the political behavior. So usually, when people would like to get re-elected, is going to try to increase the spending in order to try to look more desirable for the voters in that country. So the popularity will increase, and that obviously is something that is going to create inflation bias. The fact that sometimes political parties are like or tend to expend more when we are going to have political campaigns. So that can lead as well to the loss of credibility. So if no one believes what the policies that the Fed is performing, that can create like a lot of disturbances in the market, because in that case the Fed is going to say something and the people is just is not going to believe. So one example of this is the fact that the Federal Reserve, the Fed, said that the inflation that we have is actually transitory. And later on in their statements, many months after, they decided to say or delete the word transitory or temporary as well from the statements. And Jerome Powell said that he did not believe anymore that the inflation was going to be temporary. So temporary for him was the fact that inflation was going to come back to 2% level this year. So no one is expecting any more that, and the Fed lost its credibility. So at the beginning, markets, I think they believed what they were saying, and today, when we arrive to a more persistent inflation, I think markets are falling apart. So I believe that there is still room to fall, by the way. A law like it has potential. This situation has potential to stop the Fed from increasing the interest rate. Let's see what happens. Because if the stock market and the financial system enters in a phase of instability, that will be very serious. I think the Fed will be in the crossroads between helping the stock market or carry on controlling inflation. So the loss of credibility is very important. So I think the Fed needs to gain again the credibility. On the other hand, in the Central Bank of the United Kingdom, Andrew Bailey also took a decision that took the markets by surprise. That is also losing the credibility in the market, because agents cannot prepare to like the decisions that the Fed are taking. A little bit like in the lines of the neoclassical schools, because they believe that only shocks surprising the market might affect the aggregate demand and do not create inflation. However, I believe that loss of credibility is an asset that is actually losing value these days. So we have a Fed that has been away from many months. At least today is arriving to say that is going to increase the interest rates, but as little as 0.25, probably 0.25%. When the Taylor rule, as you saw from the previous video, is telling us that it should be now at 3%. So Professor Taylor is advocating at least to have 2%. The fact is that I don't believe the markets will be in for 1%. At 1%, there will be hiking the interest rate more than 3 or 4 consecutive times is going to be very difficult for the current environment in which we have sectors or different growth in sectors and like many bubbles everywhere, particularly in the United States. Not as much the case in China. China is different. They are trying to save the economy because they have a huge hit in the real estate market that has not been passed or communicated in a very like transparent manner to the markets, the world. So that in the other side of monetary policy, they are trying to stimulate the economy. Again, from China, this lack of transparency make agents to distrust the stock exchange there in China. So it's very difficult for us as well to take the decision on whether investing in China. So we are in this reality in which, in one hand, the United States is increasing interest rates, on the other hand, China is providing stimulus. The first economy tightening, the second economy losing the economy. This can create like a huge problem. Imagine then like a flow of capital from the United States to the stock market in China. It can happen, right? The stock exchange in China is, by the way, very, very cheap at the moment. The only issue is, well, are the current economic decisions, particularly from the Communist Party, and the fact that the stock exchange is very much linked to politics or political decisions. However, there is still a good opportunity, and is among one of the things that I am tempted to invest at the moment, particularly in the biggest stocks in China. So time lags is another case for the rules, making rules to increase interest rates. So it's very, very good, for instance, in terms of correcting inflationary pressures. So, for instance, if we have an initial under and then an over correction, the case for the rules is that they take decisions more accurately rather than human beings, yes, and also they will act upon the data. So there is just certain case there in terms of time lags, the fact that we receive the information with very many lags, and when we are going to take decisions, I think the decision might not be appropriate. And therefore, the case for another point, a case for these rules in monetary policy is that they help to reduce inflationary expectations. So everybody will know that there is a rule in the market is being followed. The interest rates is going to be we will be able to forecast better the interest rates and the decision that the government is taking. And in doing that, I think it's easier for everybody to adjust their portfolios and their businesses, their investment, and their savings to the expectations, right? To the inflationary expectations and the resulting interest rates. Also, if we know what is going to happen, and if inflations are then anchored to these rules, so therefore that can create a stable environment for investment and economic growth. We have a case for discretion. Discretion is when the central banker decides by itself to increase or decrease the interest rate. I think that is one of the most important critics that Professor Taylor was saying about the Fed at the very moment. So many people, I think many economists, do not really trust in the decisions that the central bankers, particularly the last central bankers from the United States, have made to correct the problems in the economy since Greenspan. So we have had a Greenspan, Bernanke, we have as well Yellen, and recently Jerome Powell. So discretion, we are still in discretion, even though when the problem of the pandemic happened back in March 2020. So I think we have like a better outlook of what is going to happen in the economy, and also we are again able to forecast better growth and forecast better unemployment and inflation. So one of the points, one case for the discretion of Jerome Powell without using a Taylor rule is that is needed when there is economic volatility. I do not think that the economic volatility now is coming from an exogenous or an external shock to the economy. Yes, there are geopolitical tensions with Russia. Yes, there are tensions with China, but in general, we know that the pandemic is more or less controlled by the vaccines, and there is a clear path to open the economy to the rest of the world, particularly the United States economy and the UK economy, and the European economies, the advanced economies in general as well. So that is one of the points, or one case for the use of discretion, the discretion that using Jerome Powell at the moment. And another point would be that rules can cause severe fluctuations in interest rates and can cause greater instability. So if rules can be, sometimes rules, yes, they can be manipulated, or sometimes they cannot assess very well the environment in the way that a human being will do, right? A rule, a simple equation, probably is not going to be able to assess the impact of the pandemic, the new strand of the virus, is not going to be able to assess the impact of a possible war, and or many other qualitative signs coming from the environment, yes, social, economical, political. So in doing that, I think rules can cause greater instability when we have them in the market. I believe then, therefore, that when there are these type of shocks that are random, we cannot forecast. So I believe that yes, there is a case there to discretion. So well done, Jerome Powell, for printing money very quickly right after the commencement of the pandemic back in March 2020. That saved the world. Yes, I totally agree with that. But at this very moment, I think he is very dovish and is causing harm to the economy, particularly for the poor, more because the inflation for goods like food, like energy, I think they are hitting the most to the poor. So I was reading actually the news today and was seeing what was the increment in the inflation of rice, for instance. It was something about like 95% or something like that. And that is nothing for a person that is wealthy, but for a person that is counting their coins to to buy things, I think these increments are seriously high. And indeed, we do have people in very difficult circumstances in the UK. Another case for discretion is which rule or target to choose. So there are many rules, yes. The Taylor rule is just one of them. That is something different. And apart from having the Taylor rule, there are as well modifications to the Taylor rule that the central banks might want to follow. So that is something that we also need to take into account. Rules and target may conflict. So, for instance, we are at this very moment, this like economically, the unemployment is very low, but also inflation is very low. So, if the mandate for this for the central bank is to keep unemployment at the potential and the inflation low, is what weight you are going to give to one or to the another. So sometimes that ends up in being a political game. And that is particularly what is going on in the United States, because the target or the mandate for the Federal Reserve is to control both inflation and unemployment. They both are go in the opposite direction the majority of the time, right? Most of the time. So therefore the rules and targets may be in conflict. So rules and target may become unsuitable. So for instance, in the case of the COVID-19 pandemic, that is the case. So that is a case as well for discretion in macroeconomic, in monetary policy particularly. So fine-tuning can be improved by better forecasting and quicker action. So that is another case for a discretion. So instead of using these equations, fine-tuning and forecasting inflation, and if you have the mandate to control unemployment as well, I think it's better to just forecast these two aggregates of the economy rather than setting a rule for the central bank, for the whole economy. So in terms of policy making environment, so is a consensus the use of inflation targets around the world. So now let's see what are those targets. So here we have Australia is between 2 and 3%. For Brazil is 4.25%. We have most of the countries are around 2% in this graph, and different from them, probably South Africa 3 to 6%, Israel 1 to 3%, and Hungary has 3%. Here we have details about the inflation targets. So, for instance, for Australia, it is an average over the medium term. The same say the United States. Jerome Powell said that is what he was going to try to get 2% in average, as he was unsure about whether the inflation was going to be persistent or not. I think he backtracked that during the meeting that or the comments of the Fed that we have today. So he's only looking now to come back to 2%. We do not know what is going to be the time span, so there is a lot of uncertainty in this area. So for the UK, is inflation target is forward looking, and there is a tolerance band between 1 or minus 1%. We are still far away from the 3% or the 2%. Anyway, we are in 5.4% at the moment. And even though when we are not in the situation of the United States, which has the inflation around 7.4%, yes, and probably increasing even more. So it is still, you can see that we are still far away in terms of catching up with inflation. The difference here in the UK is that the central bank already took decision the previous month. This month is not going to increase the interest rate, but it looks like in March it's going to increase again. Other countries such as Brazil, Chile, they have started to increase the interest rates since inflation there is rocketing high. So here we have the annual rates of consumer price inflation. Consumer price inflation is a basket of goods that we follow to calculate what is inflation, the level of prices in the economy. So here we have the inflation rate for the United Kingdom. Here we have the inflation rate for the Eurozone. And here we have the inflation rate for the annual rates of consumer price index in inflation for the United States. This, as you can see, this has changed. I think we have here 2020, probably the second quarter of 2020. This changed very much. You will see that the inflation of the United States is out of this chart in 7%, and the inflation rate for the United Kingdom is just above 5%. So, what are the issues of inflation targeting? Particularly in setting the rules of what is going to be the target, the choice of target is going to be 2, 3, what is going to fluctuate among the band, is going to be forward-looking, or are you going to backtrack and back forecast on what is going to be that inflation, or are you going to take an average? What is the idea of the target? Who sets the target? Is the target going to be allowed to move by the central bank? I think that is a big yes for many countries. So there is a possibility that the central bank has as a last option to do that, but obviously that will cause a lot of problems in the economy, changing the target, multiple targets. So, for instance, a Taylor rule for setting interest rates. And we will indeed use a Taylor rule later on in order to calculate the interest rates. For the moment, let's imagine that the Taylor rule then states what is going to be the interest depending on inflation and depending on unemployment, or depending on real national income, such as in the way that we have in here. So here we have this inflation target. That is why inflation asterisk is a target there. And here we have a dynamic aggregate demand curve. Yes. So, and let's imagine that we are based on the Taylor rule. So therefore, we are going to give a weight to the real national income, and as well a weight to the rate of inflation. So this curve, as it is very flat, is giving like a measure, like a higher weight to the rate of inflation rather than to real national income. So therefore, we are here in a situation in which the actual target is on the dynamic aggregate demand, and so therefore inflation is not moving. So, but now assume that we are going to have inflation in the next period. So here at this level of inflation and dynamic aggregate demand, we have this real national income. But as inflation increases, as you can see, as we are going to increase the interest rates to cope for that increment in inflation, you will see that it's going to be a huge or a higher impact in national income, because the Taylor rule is saying that it's going to be higher weight to a stable inflation rather than a higher weight to maintaining the real national income. In this case, so therefore the inflation will be in pi 1. Now let's assume that we have a different Taylor rule. This time the Taylor rule is giving a higher weight to a stable real national income. This is particularly the situation of the United States. Now they are changing from giving more weight to the real national income to give more weight to control for inflation. So in that case, the dynamic aggregate demand curve is actually coming back to the blue bit. So here we have the situation in which we give more attention to the real national income than to inflation, and you can see here that that Taylor rule will increase the interest rates to tackle the inflation rate more, and so therefore is going to give like a higher way to the real national income. In this case, in the point C, so therefore the central bank is going to be a little bit more dovish, a little bit more loose, relaxed in terms of increasing the interest rate because he doesn't want to hurt the economy. I think that is the case of Jerome Powell. On the other hand, we have here an economy that actually does not care about that, and it prefers that national income will drop massively because they want to keep a very stable inflation. I think that will be the case of China actually. And I will say that Jerome Powell is actually shifting from this green line to this blue stance on increasing the interest rates. That will cause massive problems in the markets. So also another way that we can perform in order to target inflation is to use money supply. So the last time that Jerome Powell used money supply, the markets fall massively. That was in 2018. So that was like a double whammy for the economy because apart from increasing the interest rates, he as well reduced or quantitative tightening, if you want, and that reduced the money supply. So basing interest rates on forecast of inflation, that is another issue with inflation targets. So if you base that, so therefore it will be a situation in which you are not going to be able to decide whether you are going to help the economy or the national income. So there are very different macroeconomic situations. At this very moment, for instance, debt as a percentage of GDP is already very high. So if the markets fall at this very moment, my outlook is that the central bank is not going to come to the rescue like in the same way that they did to the pandemic. In general, I believe that the central bank has run out a little bit of bullets, or if you want, to the monetary bazooka. They want to use that word to quantitative easing or printing money. So I think this is low of ammunition. Obviously, the central bank has low ammunition in terms of increasing interest rates, in my opinion, but they still have other ways to reduce monetary policy, and that was actually the previous lecture that we covered before. And finally, we have the problem of deflation. We covered the problem of this is a camp, an economist camp in terms of many people like advocating for the problem of deflation. We had that problem because of the pandemic. So I believe that yes, technology is going finally to decrease inflation in the future, in the long run. I cannot see that coming very quickly. Particularly, I can see the opposite, the fact that I can see the opposite problem, more inflation coming as commodities and many other prices are increasing. But deflation probably will come in the future when technology are going to be make things more efficient. So there have been huge investments in technology recently. Okay, guys, so this is the end of this presentation. I hope that you have enjoyed this bit. I am going to cut this video here, and well, I hope to see you next to have a little bit of a discussion about the Taylor rule and how can we calculate the Taylor rule. Is going to be great. actually to calculate the Taylor rule for the UK economy and the US economy to see what is the likeliness of increments in the interest rates. I think this topic is hugely massive, very important for those who like Bitcoin, the stock market, bonds, and trading in general. Okay, guys, so with this, I finish this recording. Thank you for listening.